NVIDIA now has the largest market cap in the world. What does that mean for investors? Wall Street is betting on regional banks, and rent increases are posing a risk in the fight against inflation. These topics and a look at updated S&P targets from Wall Street companies. Thanks for tuning in to this episode of Investment Insights from Opal. My name is Jay Coulter. Joining me, as always, Adam Mueller and Austin Graff. If you'd like to ask the team a question, please shoot us an email, podcast@opalinvest.com, or scan the QR code on your screen. Our first topic for this week is around NVIDIA, which is now the largest company in the world after surpassing Microsoft yesterday. Adam, what does this mean for investors?
Look, I don't think the simple fact that it's the largest company now means nothing to investors. I think that the size of NVIDIA and the fact that it's achieved that kind of scale based on the artificial intelligence, product suite it has and the chips, that's the important question, which is how big is AI? Can NVIDIA maintain its competitive advantage and its first mover advantage? And at some point, anytime a company makes that much money and gains that much market cap as a result and has that kind of multiple expansion because it designs a product, everyone and their mother is going to be trying to build a similar chip.
What do you think, Austin?
I think it's interesting, since the market kind of exited the trough in November of 22, NVIDIA is up over 900% and year to date up over 180%. These are just eye-popping numbers, regardless of who the company is. And as many investors are kind of transitioning to passive options, I think it really kind of demonstrates that, a lot of investors aren't participating in NVIDIA as much as they'd like to if they're doing so through passive. And if they're buying today, they're buying at a very high price. If they buy passive funds, they're likely getting NVIDIA as the largest holding at a time when, future increases are, maybe a little bit harder to come by than they have been in the past for some of the reasons that Adam referenced.
Yeah, if you're going to buy or sell NVIDIA today, don't do it because it's the largest company in the world. Don't do it because of the market cap. Make your decision based off of what you think the top line growth could be over the next 3 to 5 years, how that translates to earnings and free cash flow, the same way you should evaluate any company.
Yeah, but if you do put money into a passive index today, in all likelihood, your biggest investment is going to be in NVIDIA, a company that recently went up 9 times. So if you are concerned about that growth, it might make sense to either look for something that isn't fully focused on the broad index or look for some active options that are going to be a bit more conscious of, what you're paying for rather than just like spreading your money around the market like peanut butter. You'll end up with some lumps in there like NVIDIA.
Our next topic. There's an interesting article in the Wall Street Journal this week around Wall Street taking notice of what's happening at the regional banks. Austin, what's your take and what do investors need to know?
Yeah, I think that the point is these synthetic risk transfers, which is a fancy way of saying offsetting the risk from their loan portfolios to other investors is taking place. And, one argument is this is happening to comply with some regulatory requirements that are changing. A pessimist, though, might look at it and say, hey, these banks didn't actually know what they were underwriting, and they're trying to offset that risk. It's more likely a combination of the two, but I think leaning towards the banks didn't really understand what they were underwriting because they're paying a pretty significant price to get these things off their books. They're actually paying hedge funds double-digit yields to insure against losses in their loan books, which does free up capital, but it puts a big dent in their income statement because they have to pay those double-digit yields to go lend to other companies. So I think that there could be more risk to come. Another thing on the back end of that is there are the actual financing of the purchase risk transfer actually just spreads that risk out to other banks in the system. So if we were trying to improve the systemic risk embedded in these portfolios by offsetting the risk to hedge funds, it's not working because the hedge funds are just reaching out to other banks who are financing those pools, and you're just transferring that risk to other banks, which tend to be foreign banks.
Kind of smells like 2008 and 9. Adam, what's your take?
Yeah, I was about to say that, Jay. You read my mind. It's like not the first time that banks have looked at their balance sheets and gone, "Oh, whoopsie, what's this?" and then tried to find a bigger dummy, right? Like remember the leading up to the global financial crisis when a bank would look at its balance sheet and say, "What are all these weird mortgages? Oh, let's just package them up and sell them to Iceland." They can't read the fine print. It's dark 24 hours a day. Like it's the same story that just plays out again and again. And hopefully you'd hope people have gotten a little more savvy and a little more careful. But the reality is it's very tough from the outside looking in to look at a bank's balance sheet and understand what's there. They know, and the royal we, in terms of everyone else who's not in the bank, it doesn't know.
The most telling thing should be that JP Morgan did a transaction towards the end of last year to transfer $20 billion of risk off of their balance sheet to the balance sheet of others. Do you think if JP Morgan thought that all of those loans were money good, they'd be selling it to other parties at a double-digit yield? Probably not. So I think people should remain somewhat skeptical. I think if we were to look out on the horizon and try to identify where there could be a problem in the market that causes the Fed to react aggressively, it's probably something linked to these portfolios, as many of the banks that know best are trying to get rid of them.
Yeah, if Jamie Dimon's going to give to charity, it's going to be the hair club for men so more people can be a sexy silver fox. It's not going to be just gifting other banks, assets that have a high return on investment.
Next topic. Most Americans are still feeling the impact of inflation. And there's an interesting article in the Wall Street Journal about how rent increases are really hurting the fight against inflation. Austin, how should investors look at this dynamic?
I think this is one of the more interesting things out there because, there's a contingent of people in the market today talking about how higher interest rates are inflationary. And quite frankly, I've thought that that's a bunch of nonsense because they're saying, people are generating higher yields on their portfolios. So then they're turning around and spending that money in the market and creating an inflationary environment. I think that argument's nonsense. The part of the argument that I think makes sense is the fact that higher interest rates are preventing new housing starts from taking place in an environment where the U.S. is already significantly undersupplied in housing. And so as we see the housing starts to slow and we continue to have housing formations in the U.S., it pushes up the prices. We all know supply and demand from Econ 101. It pushes up prices on housing and creates this inflationary environment that I think the Fed may have a hard time addressing because as they reduce rates to address the housing issue, they're likely inflating other bubbles in the market.
Adam, what do you think?
Yeah, it's a really interesting dynamic, right? Because as rates go up, mortgage rates go up. It becomes more expensive to buy a home. And if you have a mortgage that's locked in at 3%, 4%, 5% because you got it 10, 15 years ago, you don't want to leave because then you want to keep that mortgage. And housing is a supply demand market, just like most markets. And that's created, that's created some havoc in how the system's actually working. And then more people have to rent, right? But then there's not enough rent. So the supply of renters goes up and then the rent goes up. So in this weird sort of perverse way, these higher rates have impacted housing markets. But is it higher rates or is it the inflation that actually is the ultimate cause of rent is just the price of an apartment, and the prices have gone up. It's not dissimilar to the price of eggs and other things, but it's a real problem. And it does feel like the Fed's mechanism of slowing the economy in this cycle doesn't seem to have worked as well as it may have in the past.
I think this is a problem that the Fed can't fix with straight monetary policy. We need more regulation of some sort, or reduce regulation for that matter, in order to address this issue and create more available housing. And it comes down to the Fed has this very blunt tool of monetary policy. It can't fix everything. And so just because, you have a hammer, you shouldn't treat everything like a nail. The Fed may need some help from others in Washington to address this situation.
Yeah. And it's also a generational issue. I mean, if you're under the age of 35, it's incredibly difficult to secure housing because of rates, find housing, and then you end up paying more for rent. And that's going to create some real rifts going forward. I wonder if this is going to become a topic here as we head into November.
And then you think to yourself, I probably shouldn't have gone to a liberal arts school and majored in slam poetry.
Our last topic for this show, we are reaching the midpoint of the year. It's time for Wall Street firms to start updating their end-of-year forecast. Adam, what's your take on what you're seeing in the market?
Well, it's interesting over the last week that several large banks have increased their estimates for the S&P 500 is going to end the year. Goldman and Citi went up to 5,600, which now after the last couple of days is only a few percent up from where it was. But their previous estimates would have required the market to actually fall, which clearly they don't think is going to happen. And Evercore went up to 6,000 from their previous level of 4,750. So they're thinking there's another almost 9.5%, 10% of gains for the year. And look, I have a lot of sympathy for people whose job it is to estimate where the S&P is going to go over the next 6 months. I'd rather guess when Taylor Swift gets married than where the S&P is going. That's a very difficult task, and you're never going to get it right. And all that's really happened is that the market's done well over the first half of the year, up 15% or something. And they've said, well, we don't necessarily think it's going down, so we got to adjust our numbers. It's not rocket science. I wouldn't put too much faith in any of these numbers. I think that the information they're really telling us is more just directional than anything else, which is they're saying, hey, I think the market, I don't see an imminent crash, and I'll adjust my numbers if things change.
Yeah, I think that they tend to chase the market around, and occasionally you'll get a rogue economist who comes out with a different view. And, once in a while they're right, but more often than not, they're wrong. And so one of the more interesting things to focus on is just what's the expectation for earnings growth versus where valuations are today. Valuations at 21, 22 times forward earnings estimates are relatively elevated. You've got expectations of anywhere between 10 and 11.5% for earnings growth. And by the way, we've already seen, a 15-ish% increase in the S&P 500 this year. It indicates that these economists expect either earnings to accelerate in the back half of the year, or they expect valuations to continue pushing higher. It more than likely indicates that valuations are going to continue pushing higher because the Fed's expected to reduce interest rates. Is that going to be what actually happens? Nobody knows, but they're not going to change that estimate until something bad happens that pushes the market down 10+% most likely. So if you're listening to these economists, you're always going to be behind because they're always reacting to what the most recent move was in the market.
Yeah, to your point, Austin, Goldman, when they upped their estimate, said it was due to higher fair value PE multiples. So they're basically saying we're gonna assume the market has a higher multiple for a little while, and therefore our estimate goes up. What I found fascinating, though, and the most interesting comment was when Citi's increase, where they attributed it to investors are living in unusual times. What does that mean? I don't know. If someone said, "Hey, you should buy this thing," why? Because we're living in unusual times. I think I would tell them to go pound sand.
Gentlemen, thanks again for a great podcast. Viewers, listeners, learn more about Opal Capital by visiting opalinvest.com. Submit questions, and we'll answer them on your next episode by emailing us at podcast@opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.